We've been taught to chase safety, keep money in banks, buy insurance, avoid risk. But here's the paradox. The people who seek safety often lose the most wealth. The people who understand risk protect their wealth best. Meanwhile, the wealthy live by a different rule. Protect the downside, and the upside will take care of itself. That's how they survive recessions, crashes, inflation waves, even wars. Because they don't just build wealth, they build a wealth shield. And in this video, I'll show you exactly how to build yours, step by step. A system designed not just to grow money, but to keep it. Class begins. If you want to protect wealth, you must first know what's attacking it. Let's break down the 4 enemies of wealth that silently destroy fortunes. Enemy 1, inflation, the silent killer. Inflation doesn't come with alarms. It doesn't crash markets or make headlines daily. But year after year, it eats the value of your money. Example: 1 lakh rupees saved in 2010 has the purchasing power of roughly 60,000 rupees today. The wealthy fight it by owning real assets, stocks, real estate, commodities, that rise with inflation. The middle class tries to save their way out of it and loses quietly. Enemy 2, taxes, the visible thief. Every time your salary arrives, the government takes its cut first. But when your assets grow, the rich use systems to minimize what they pay legally. Salaries are taxed highest. Capital gains and dividends, lower. Real estate depreciation, retirement funds, trusts, even lower. They don't evade taxes, they plan around them. Understand the difference, and you keep more of what you earn. Enemy 3, bad debt, the modern trap. The system trains you to borrow early and borrow often, for homes, cars, gadgets, even vacations. But debt isn't evil, it's just a tool. The rich use it to buy assets. The poor use it to buy liabilities. Example: AR's 15 lakh loan for rental property pays itself off every month through rent. The key is simple. Borrow only when it creates future cash flow, not when it buys momentary comfort. Enemy 4, emotional investing, the self-inflicted wound. The wealthy don't let feelings drive finance. They use rules and systems, asset allocation plans, stop-loss thresholds, yearly rebalancing. So here's your first truth. Wealth doesn't vanish overnight. It bleeds slowly through inflation, taxes, debt, and emotion. In Chapter 2, I'll show you how to design your wealth moat, the protective walls that keep your money safe even when the world outside burns. Every castle that stood for centuries had one thing in common: a moat, a protective barrier that kept invaders out, storms at bay, and rulers safe within. The rich build their wealth the same way. Let's build yours, step by step. Layer 1, the liquidity buffer. This is your first shield. It protects you from panic and forced liquidation. Most investors lose money not because markets crash, but because they're forced to sell in panic when they need cash. The wealthy avoid this by keeping 6-12 months of expenses in liquid form. Savings account, minimal. Liquid mutual funds. Short-term government T-bills or money market funds. Example: if your monthly expense equals 1 lakh rupees or $1,500, Layer 2, diversification of assets. Once liquidity is secure, the next moat is diversification. It's about owning different ones that behave differently. The wealthy spread exposure across asset types, equities, bonds, real estate, commodities. Sectors: technology, energy, healthcare, finance. Layer 3, inflation and currency hedge. The rich protect themselves through inflation hedges, like gold and silver ETFs, commodity exposure, energy, metals, agriculture, real estate and REITs, inflation-indexed bonds, I-bonds, TIPS, RBI inflation bonds. Layer 4. Global hedging, geography as protection. Wealthy families don't keep all assets in one country or one currency. Their hedge includes international ETFs, MSCI World, S&P 500, dollar or euro-denominated funds, overseas property or digital businesses generating foreign income. Example: if the rupee weakens 10% against the dollar, your global ETFs rise automatically, offsetting losses locally. So here's your second truth. Wealth isn't protected by luck or timing. It's protected by layers: liquidity, diversification, inflation hedges, global reach. In Chapter 3, we'll explore one of the most misunderstood yet powerful layers of all: insurance. When people hear the word insurance, they sigh. It feels boring, complicated, maybe even unnecessary. But here's the truth: the rich don't see insurance as an expense. The wealthy understand this deeply. They don't rely on luck. They rely on protection. Every risk has two costs: the cost of probability, how likely it is; the cost of impact, how devastating it would be. 1. Term life insurance, protecting your family's foundation. This is not an investment, it's a risk transfer plan. Term life insurance ensures that if the wealth builder, you, is gone, the family still has enough capital to survive, pay off debts, and continue investing. Example: if your family's annual expenses are 12 lakh rupees or $15,000, you should have a life cover of 20x that equals 2.4 crore or $300,000 minimum. 2. Health and critical illness insurance, guarding against medical bankruptcy. One medical emergency can wipe out a decade of savings. That's why wealthy families hold comprehensive health cover, 25 lakh rupees or $100K plus. Top-up plans to extend base coverage. Critical illness policies that pay lump sums on major diagnoses. It's not just about hospital bills. It's about maintaining financial continuity when life pauses. 3. Asset and liability insurance, protecting what you own. Rich individuals don't just insure their lives, they insure their assets. Home insurance protects property from fire, flood, and disaster. Vehicle insurance covers liability beyond legal minimums. 4. Wealth and legacy protection insurance. As wealth grows, so does responsibility. That's why high net worth individuals, HNWIs, use estate and keyman insurance to protect inheritance and business continuity. Keyman insurance protects companies if a crucial executive or founder passes away. So here's your third truth. Insurance isn't a burden. It's a lever. It's how the rich stay rich, even when life throws the unexpected. In Chapter 4, we'll tackle one of the most misunderstood tools in personal finance: debt. How the rich use it as leverage to grow faster, while others drown in it unknowingly. If you ask the average person what they fear most after losing a job, they'll say debt. Debt keeps them awake at night. But here's the irony. The rich use the same tool, debt, to build empires. So, what's the difference? It's not the tool. It's the intent and structure behind how they use it. Example: the car versus the apartment. You borrow 15 lakh to buy a car. Value next year, 12 lakh. Cash flow, 0. Outcome, liability. You borrow 15 lakh to buy a small rental apartment. Rent, 15,000 per month equals 1.8 lakh per year. Value after 10 years, 25 lakh plus. Outcome, asset. Both are loans. One makes you poorer, one makes you freer. The rule, the debt-to-income discipline ratio. The rich follow one rule for debt sanity. Total EMI or debt obligation. Seat 25-30% of monthly income. Example, if you earn 1 lakh per month, all EMIs combined shouldn't exceed 25 to 30K. That's the line between leverage and overexposure. They use debt as a servant, not a master. Because the moment you owe more than your income can support, you lose freedom. How the wealthy think about borrowing. 1. They borrow with purpose. Every rupee borrowed must produce more than it costs. 2. They borrow with exit plans. Every loan has a payoff strategy: refinance, rent, or business cash flow. 3. They borrow at low interest, invest at high return. That's how they profit even while owing. 4. They never borrow to impress. They borrow to progress. So here's your fourth truth. Debt isn't dangerous. Misused debt is. The poor avoid all debt out of fear. In Chapter 5, we'll tackle the final and most critical element of your wealth shield: behavioral risk management. You can master every formula in finance. You can diversify perfectly, buy the best assets, manage risk precisely. But if you can't control your mind, you will still lose. Because money doesn't move rationally. People do. Let's decode how. The 5 biases that destroy wealth. 1. Confirmation bias. You seek information that supports what you already believe. If you think this stock can't fall, you'll ignore every sign that it can. Fix. Write a pre-mortem before investing. Imagine what could go wrong and how you'd react. 2. Loss aversion. Psychologists found that losing 1,000 feels twice as painful as gaining 1,000 feels rewarding. That's why investors freeze when markets drop. They can't bear to see red. Fix. Accept that losses are temporary if your system is long-term. Volatility not equals loss. Selling in panic equals loss. 3. Recency bias. You assume the future will look like the last few months. After a bull run, you think it'll rise forever. After a crash, you think it'll never recover. Fix. Zoom out. Long-term charts remind you that time beats timing. 4. Herd mentality. When everyone's buying, it feels right. When everyone's selling, it feels safe. But by the time the herd acts, the opportunity is gone. Fix. Follow data, not drama. If your conviction comes from social media, it's not conviction, it's noise. 5. Overconfidence bias. A few wins make you believe you're smarter than the market. You double your bets, and one wrong call wipes out years of gains. Fix. Humility. Even the best investors lose. The goal is survival, not ego satisfaction. So here's your 5th truth. You can't manage money until you manage your mind. In Chapter 6, we'll bring it all together. The final Wealth Shield Blueprint. Your step-by-step framework to protect, preserve, and pass on your wealth safely for life. You've learned how the rich build, diversify, and defend their wealth. Now, it's time to assemble it. Your personal wealth shield blueprint. Step 1. Build the foundation, liquidity and emergency. Start with peace of mind. Your first layer is cash flow continuity. 6-12 months of expenses in liquid form. Use high-yield savings, liquid funds, or short-term T-bills. Never invest your emergency fund. Its purpose is survival, not returns. Step 2. Protect the core. Insurance. You can't grow wealth if life knocks you off course. That's why the rich treat insurance as defense, not fear. Term life insurance. 20 EGs your annual expenses. Health insurance. Sufficient to cover modern medical costs. Critical illness and disability. Cover for income continuity. Asset insurance. Homes, vehicles, business equipment. Step 3. Manage debt intelligently. Debt isn't evil, it's energy. Channel it right. Keep total EMIs, so it's 30% of income. Borrow only for assets that generate income or appreciate. Avoid consumer loans and revolving credit. Use leverage with structure, not emotion. Step 4. Build global diversification. Think beyond borders. Inflation, taxation, and crises don't respect geography. Allocate 10-20% in global ETFs or index funds. Own assets across multiple currencies, USD, EUR, INR. Use REITs, digital businesses, or international exposure to balance local risks. Step 5. Add inflation and crisis hedges. Inflation is the slow leak that empties every bucket. You counter it by owning assets that rise as currencies fall. Gold and silver ETFs, real estate and REITs, inflation-linked bonds, commodity ETFs. Step 6. Install behavioral systems. You can't control markets, but you can control behavior. Automate investments. Rebalance yearly. Keep a written plan. No decisions on emotion. Review with logic, not headlines. So build your wealth shield, quietly, patiently, deliberately, because your wealth will stand if your foundation is built right. If this series helped you see money differently, don't let it stop here. Subscribe, because this is only the beginning of a new kind of financial education. Comment. What's the first layer of your wealth shield you'll build this month? Share. Send this to someone who's making money but not protecting it.